Support and resistance, pretty much the driving force behind all markets. When we know where the buyers and sellers are, support and resistance, we gain a major edge. I'll be showing how support and resistance areas act like invisible barriers, stopping price in its tracks or propelling it forward once the area is broken. So when support becomes resistance or when resistance becomes support. Plus, I'll explore how candlestick patterns like bullish and bearish engulfing patterns help you identify these key zones with pinpoint accuracy. After I go through everything, you'll see why properly identifying support and resistance areas keeps you from buying right into resistance or selling into support. So it helps you better timing on your trades and how it opens up clear targets for your trades. Sounds good? Let's jump straight in. The first thing we're looking at is marking out our level of resistance. So we can see that price rallied, has gone higher, and now we have a bearish engulfing candlestick pattern. So the reason it's a bearish engulfing candlestick pattern is because on this candlestick, the bearish body in red is larger than the previous bullish body in green. So this is a bearish engulfing. Look at my previous videos that will give more of an explanation. Now I'll just mark out a rectangle on this area. And based on my experience, the way I mark out levels of support and resistance, it's not just one line, it's an actual area, quite similar to when we did the marking out area for Fibonacci between the 38.2 and 61.8 level. So I place one line at the highest point of the engulfing candle, and then I place another there. So now we have our area. So what I'm doing is I'm just dragging across the box so we can see that this now is our area of resistance. Anytime price reaches either this lower line here or within this area or the upper line, this is our area of resistance. If price surpasses the upper line, then that would mean that this area of resistance is no longer valid and we wouldn't take sell signals. But for now, what we're doing, we'll go across on the chart, and price is not trading within our area, but if price reaches our area, we'll then look for sell signals. So I'll scroll across, I'll zoom out so we can still see our area. So price went down until eventually price has reached our area here. And once price reached, you can see that the sellers or resistance, push price back down. So we had a sell signal. Based on our strategy, if we entered the market once price touched our area, we could have entered and placed the stop loss at the highest point of the level of resistance and then made a profit from our entry down to here. So that's how we would have made profit that way. This area of resistance is still respected all the way until price surpasses the upper line. If we look at this candlestick pattern here, we have a pin bar, which is also followed by the next consecutive candle, which is a bearish candle. I'll look at another bearish engulfing pattern. So we have this pin bar followed by a bearish candlestick. You can see that the bearish candlestick body is larger than the previous bullish candlestick body. So we have a bearish engulfing candlestick pattern. Again, for the same thing applies when I draw mine. I draw my upper line at the highest point of the engulfing pattern, which we have here, and then I draw mine at the low. So what I'll do again is I'll mark out the area similar to before, just to make sure that when price reaches our area, we know that it's a level of resistance. So I'll scroll across. And as we can see, price touches it slightly here. Price touches our level of resistance here and then goes down. And then price re-enters our level of resistance and then goes down again. So if we look, this is our area of resistance. You can see that price touched it a little, then it re-entered our area. Price was pushed down rapidly and we could have made profit. Now we're going to look at an example of where a level of resistance can become a level of support. So what I'll do, I'll look at these two candlesticks. We have a pin bar and a bearish candlestick. So I'll just mark out the area now. So the same rules apply. I'll just mark out my level. So I've marked out the two. I like to have a upper line as well as a lower line. And what you can see is we have a level of resistance. Price reaches our level of resistance. There's a little bit of sellers there until eventually price breaks and goes above our level of resistance. So now that price has gone through our level of resistance, this is no longer a respected level of resistance. But what does happen is resistance can then become support. What was once resistance becomes support. So now I'll change the color and make it green. So this was previously our level of resistance. Price stayed around until the price eventually broke, and then price retraced and found the level of support within our area of resistance. So what was once resistance becomes support. This happens a lot, and as you can see, the trade went off in our favor and you would have made profit. So now we'll look at a bullish engulfing pattern used as a level of support. So we see that price rallied up and then started to decline. Then we have a bullish engulfing candlestick pattern here that I'll just highlight. And we're looking at these two candlesticks here. The reason why it's a bullish engulfing candlestick pattern is because we have on this green candlestick body, or this bullish candlestick body, you can see that it's larger than the previous red candlestick body. So we have a bullish engulfing pattern. So now I'll just mark out the level based on my experience using two lines. And I'll mark out the area. You can see that price rallied from that point, reached a high, then retraced, found the level of support around here and slowly went up until sellers pushed price back into our level. But as you can see, price didn't go as low as our lowest low within the level. So you can see that even when price entered our level, we're still at quite a distance away from our lowest point. And again, when you're using support and resistance as a way to mark out your technically safe stop losses, you'd place your stop loss at the lowest point of support, which is here. So you'd still be well within your risk parameters. And then once price was in our level, the support or the buyers kicked in and made our price rally, and you can see that you would have made profit. So that's just another example of how to use bullish engulfing candlestick patterns or any kind of candlestick patterns as a way of marking out levels of support. Key points: candlestick patterns are a great way to identify support and resistance levels. Remember, support can become resistance and resistance can become support. Just make sure you're paying attention to what the market's trying to tell you rather than what you want it to tell you. The market shows no love. Be sure to check out my website, trader187.com, and join my free Discord. It's packed with content that'll deepen your knowledge. I've taught these methods to many other traders, and they often see instant clarity on their charts and improved results almost right away. You have to do some practice, but it makes more sense. If you're looking for that extra edge, feel free to reach out about my mentorship program. I'm here to help you on your trading journey. Make sure you stay tuned for the next videos. I've got a lot more coming. Peace.